Hi, everyone. Good morning. What a privilege to be with you in presumably your homes this morning on this Good Friday. I want to thank you all so much for the last several weeks, just the amount of support that we've gotten, the amount of encouragement for everyone who signs up for this, right? It just reaffirms to me and to my team that we are serving you well. And so I thank you so much for, letting us know what kind of programming you're interested in, for letting us know what questions you have that we can help answer. And so in a time where we are also physically disconnected, how cool that we are all adapting together to find ways that we can stay connected. Certainly running for 10 years, a business model that was a live events business presented some challenges when we were forced to social distance. And I'm so proud of my team for coming up with solutions to that, and that we are still able to show up and serve our community, right? Now was not the time for us to just work on internal things. It was the time to show up for you and ask ourselves, how can we make meaningful connections online? And this is one way that we have found that we are able to do that. So thank you so much. I hope you are comfortable. I hope you're in your pajamas and have your coffee. It is a privilege to be in your home and with your time this morning. So thank you so much. We've got 60 people on, which is great. We have over 100 people registered. So thank y'all so much. So why are we doing this, right? We're doing this to answer your questions and to make meaningful connections. Some of the things that we're going to cover over the next 45 minutes, we're going to talk about the overall state of the market. We're going to touch on liquidity. We're going to talk about rates, loan products, forbearance, jumbo loans. So we're going to cover it all. And what we don't cover, you can let us know. So you have, all of you at the bottom of your screen, you have a Q&A icon. And so please use that, right? Let us know as we're going through what questions you have, and I'll make sure that I direct those over to our panelists, because this is really your time. And I wanna make sure that what questions you have regarding lending and the market, that we get answered from our panel of experts. I would love to, I'm going to introduce our panelists now. I feel very privileged that at Platinum Top 50, our partners are the cream of the crop, right? We are so privileged to be in business with top-notch professionals, and how cool that we could bring you 4 different professionals to share their different insights with you. So again, just the power of diversity and the privilege it is to work with them. So let's bring them on one at a time. So let's go ahead and start, ladies first. Nikki Salter, will you join me here in digital world and introduce yourself? I'd love for you to tell us just a little bit about how you got started in lending.
Sure. So thank you for doing this and providing this level of education to all of the agents out here, and bringing all of us lenders from different backgrounds and different companies to come together to share and educate. It is so important right now and inspiring to see how everyone has adapted. So thank you for spearheading that. My name is Nikki Salter. I'm with Legacy Mutual Mortgage here in San Antonio. We're a residential mortgage lender. I've been doing residential finance here in San Antonio for the past 18 years. This is my 18th year. I closed my first loan at 10. And I've been at Legacy for over 7 years now. Super happy to be here. And this is a great time, I think, for all of us to just come together and see what everybody else is doing and how to get through this and not just survive, but thrive. So thank you for having us. I look forward to being here.
Awesome, Nikki. Thanks so much. Lori Allen, I would love to introduce you to our audience. So Lori, if you'll come on and introduce yourself.
Good morning to everybody. So thank you so much to Platinum 50, PT50 for inviting me to participate. This is such a uncertain time, and everybody has had to make adaptations so quickly to the market. So I am just honored and privileged to be on the panel and be able to share with everyone what we're doing here at Security Service Federal Credit Union. I'm the Senior Vice President over Mortgage Services, and then also over our Security Service Title Company. So it has been, needless to say, a very dynamic last 30 days as we've, put a lot of our staff mobile. They're not here in the office where they would normally be together. I have been with Security Service for 7 years. Prior to that, I grew up in Florida. So I was there almost 30 years in my career. So I definitely, uncharted territory for all of us. But I think the most fantastic part of it is our ability to all work together. To come together like this is just absolutely amazing. And I think that today's discussion is going to give a lot of great insight to the team out there. So thank you for having me.
Absolutely. John Hudson, will you join me? John Hudson.
I am. All right. Good morning, Miss Amber. How are you?
Doing great. Thanks so much. Good to see you.
Yes. No, this is awesome. Again, yeah, thank you for putting this together. You've got a great group of local San Antonio-based mortgage professionals, and I think that's so important that we are all local and serving this market. So, yeah, I'm John Hudson, Senior Vice President over here at Mortgage Financial Services. I've been doing the mortgage gig now for 22 years, which is pretty fascinating when I stop and think about it a little bit. But I consider myself a mortgage geek, and I'm definitely a student of the business. I'm passionate about it, and our organization, we serve our real estate partners out there through our distributed retail channel. So we've got loan officers on the street. And then also even through our independent mortgage broker channel. So there's a lot of mortgage brokers out there that we serve to help ultimately serve you and your clients. So yeah, I think that the biggest thing is this is a strange time. It's definitely a blip in history, and it's going to change the way that we all do business. And you've got a great panel that you've put together here of, again, local mortgage professionals that will help dispel a lot of the myths that are out there.
Awesome. Thanks so much, John. I love your Easter jacket.
I only get to wear it once a year. So.
And John, so geek is the new chic, all right? So it's like, it's good to be a nerd these days, right? We like that. Speaking of nerd, I'm kidding. Todd Schneider, one of my favorites from Jefferson. Todd, will you say hi to everyone?
All right. Hi, good morning, everybody. Thank you, Amber. I should have put my glasses on for today for you. Apologize. No, I'm Todd Schneider. I'm with Jefferson Bank and honored to be here. And wow, what a time for us to have rapid fire changes coming at us throughout the day, every day. What we talk about this morning could change this afternoon. Everybody just has to be able to be flexible, to adapt. I think there's going to be a lot of silver linings coming out of this, and we're excited about that. But of course, we got to get through it all together. And it's good to have information, and I love the people that are all on this panel that are going to share what they know today. So I've been with Jefferson Bank for 8.5 years. We've been around for over 70. We're privately owned. We're local. I've been in banking for 22 years. I actually got out of the business from 07 to 11. So I got to miss 08 and but I did come back to the aftermath. Which was kind of crazy. I felt like I had to relearn the business, to be quite honest. But it's been a fun ride, and I'm excited to be here today and excited to see what everybody has to say and the questions that everybody has. So thank you.
Awesome. I love that. And as you guys know, I always want to make clear, I am not an agent. I just have the privilege of knowing a lot of them and putting on programming, so kind of absorb through osmosis what it's like. But I always think it's important to have an agent for that perspective. So Kevin Crawford, will you come on and introduce yourself? And I just want to say I appreciate you being here to help frame things up for our audience, since we know that most of everyone listening is a realtor this morning. So Kevin?
Yeah, I appreciate you asking me to take part. I did go through 08. So I actually started in 05 or 06. And things were good and things got really bad. But I'm excited about it because I saw the aftermath, and I think it made me a stronger agent. I think it made me better at my job to learn how to hustle, learn how to get deals done, learn how to be creative. So now that we get to this, we come back into another time in history, we got to be a little more creative. I've been there, done that. And this is nothing like '08 from what I've seen. I can't tell you that it's going to change or that it's going to become like that, because I don't think anybody knows, but I can tell you right now, what we're going through right now, we just got to get a little bit creative, ride this out, and we'll be good. So I'm here to learn and see what's going on in the lending world. I'm an expert at what I do, which is selling stuff, but I take advice from the pros on the money side of things. So I'm just as excited to hear what they've got to tell us.
Awesome. And yeah, I see some Q&A already coming in. So Carmen, yes, Nikki is going to touch on forbearance. So we've got that covered, but keep y'all's questions coming in, and I'll make sure that we do get those addressed. So get those on the table. We are here to serve you with whatever questions you want. I did a little quick math, and it looks like between the 4 lenders that we have over 80 years experience. And so we appreciate you all sharing your wisdom, right? And yeah, that's when I bought this business. And so I was never up high and then came down. I just took crumbs as I could get them to build my way up. So this is my first kind of crisis to manage through. And you're right, I feel more empowered the more that I know. So let's get into it. Lori, I would love to start with you and ask you, right? So if we look at the 2 most recent crises that had market impact, that would be 9/11, as well as the mortgage meltdown of '08. I'm curious from your perspective, how does this COVID crisis compare?
Well, it's kind of interesting, right? When I thought about this question, with 9/11, I think it was an instant shock to the country. The uncertainty of our future, it's kind of, when I looked at it, both crises, from the perspective of COVID and 9/11 started in New York, right? New York was the catalyst, right? And the hub of the, the markets. And so when I look at 9/11, I think it's more psychological that was driven. I think that the mortgage market itself was impacted financially, but this is something, with COVID, that's not just financial, it's also the virus spreading and social distancing and new ways to communicate. So when I thought about it, the mortgage meltdown was sort of like laid the foundation for us on how to deal with COVID, right? We've got, I think Nikki's going to talk about the forbearance that we're going through on the servicing side. And so being that I was in that servicing side as well in a leadership role and over the origination side with the mortgage meltdown, I think we're going to be able to draw a lot of analogies and experience. And like we've all said, this is a rapidly day-to-day, moment-to-moment, hour-to-hour. We're getting updates from our GSEs, from the regulators on how to kind of navigate these waters. I think that the big difference with the meltdown and what we're seeing with COVID, if I had to draw the closest similarities, I think it would probably be the mortgage meltdown more so than 9/11. And the reason I say that is, it was the subprime market kind of was that catalyst. Borrowers couldn't afford to make payments. And then rates were higher at that point, where with COVID, we started the year with a boom, low rates, everything was looking so bright. And then, COVID came on us, shelter in place, something that, I never thought I'd have to deal with in my lifetime. But I do think, honestly, we've got a lot of good structure in place because we learned how to deal with borrowers not being able to perform. But I think the COVID is going to have a higher magnitude and significance because of the number of people impacted, job loss. I just, I think that's a big differentiator between the two.
It's interesting to hear you say that. And I love your perspective because, again, me, not a mortgage professional, not an agent, I would have thought that there would have been more similarities to 9/11 and that this was like a sudden, unexpected,
Right.
It was like an economic outlier that no one could have predicted. So I appreciate so much your insights because it's different than what I would have thought I knew,
Yeah.
which I don't. And so from a lending perspective, you consider it to be more.
I think it's going to have more impact. It's going to hit us not only on this, the origination front, I mean, refinances, you know, we still have an extreme amount of volume because rates, the market has been so volatile, and I'm sure the other panel members can share, you know, their experience, but rates are still unusually low. And in this type of healthy market, if everything was great, resales would be booming. I mean, it would all be augmenting the refinance crunch that we're under, but that's continued. Oddly enough, because I think we've come so far online with people being able to apply and communicate with us, we've still got a lot of that volume. Listen, guys, I think there are brighter days ahead for the resale market. I think it is going to, you know, as we see this virus start to flatten and things start to ease back up, right, into to more normalcy, I think what we're going to see, because of the good rate environment that we're in right now, I think that we're going to just see that purchase curve probably elongate. We're probably going to see a lot of activity in the fourth quarter, where we tend to slow down near the holidays and all of that. I think just because of the pent-up demand, you know, I'm really being cautiously, I guess, optimistic, but very optimistic that brighter days are ahead and we're going to get through this. And how do we do that? By working together, just like we're doing right now, right?
Absolutely.
No walls.
Well, you mentioned rates, and I know we've had a lot of people asking questions. So John Hudson, with the topic of rates, I'm wondering, why are rates so volatile right now, and when do you think they might stabilize?
I'm going to put on my crystal ball, right? And, you know, I'll just say this right out of the gate. There's so many factors that go into what drives mortgage rates. And I think to kind of get a good, clear picture of where we're at, we kind of have to go back and look at where we were just a little over a month ago. So right as the coronavirus started to, I think once the market started to really realize that this is a big thing that's going to come in and have a severe impact on the economy, you saw the massive sell-off in stocks, but you also saw the 10-year treasury drop to 32 basis points, which is historical low, never been that low. And then what happened with that was mortgage rates dropped suddenly to historic lows. But the problem there is that they dropped so fast that they effectively broke the market. There was such an increase in demand right away that you had lenders that simply, I mean, nobody has the capacity to take on to refinance $5 trillion worth of mortgages in 30 days. You have now markets again getting spooked for early payoff risk. So all the loans that we originated even in the last 2 years are now calling to refinance. Well, if they refinance now within the first couple of years, then that effectively makes the value of the mortgage-backed security that drives that mortgage rate zero, worthless. So if loans pay off too quickly, nobody wins in that. So it broke the market. And then what you saw was the Federal Reserve came in and said, hey, we're going to buy mortgage-backed securities. And keep in mind, that's separate from the 0% interest rate deal. I'll touch on that in just a second. But so then you had the Federal Reserve come in and say, we're going to buy mortgage-backed securities so we could prop up the value of these mortgage-backed securities. So then what that prompted was every lender in America that effectively hedges their pipeline was now getting margin calls from their broker dealers on Wall Street. And so you had every lender in America now having to fork out millions of dollars in cash to cover their pipeline that was fixing to go out and close. So now you created a liquidity issue. I mean, do you have, nobody has that much cash. And then on top of that, now you have default risk because you got mixed messaging from the government that makes it sound like, and I know Nikki's going to talk about forbearance, but now you've got everybody worried about whether the loans that they're originating today are going to default, tomorrow because they have that, because somebody wants to skip a payment. So you've got so many factors in play, and the market is still broken. Right. And yes, while we're seeing a low interest rate environment, rates can't go any higher because everybody knows that rates should be lower. Yeah. And so no one's going to buy mortgage-backed securities higher. So there's no premium in loans. And I think just to put this into perspective, there are good loans today that I can go out there and sell on Wall Street that are worth less than 3%. So that are worth this loan that I originated is worth less than a realtor's commission.
Right.
So just to put that into perspective, so what we're seeing now is, yes, mortgage rates are still low, but depending on the consumer's qualifications, you might see a higher cost for that
Right.
loan.
Well, and I know a lot of people have the question, right? Should I lock now or should I wait? And if I do lock now, what would be the options for relocking if they drop further? So how would you answer that question? And again, when I say you, remember, right, we're here to educate agents. And so we want realtors to feel like after this conversation, they can go and talk to their clients with confidence. So framing it up in that, what would you tell agents, in other words, when they get asked by someone, should I lock now or wait?
So the short answer is I would float. And the reason that if I'm not closing in the next 20 days, I would effectively float and just wait for the market to move, because we're starting to see it now as the Fed continues to pump more money back into the economy to kind of prop it up. You have seen stock prices rebound a little bit, but just in the last few days, we as lenders have seen some more margin come back into loans. And so, again, with that, so I would say if you're not closing in the next 20 days, I would float it. Okay. Because even this weekend, the FHFA, the FSOC, Mortgage Bankers Association, basically all the stakeholders are getting together to help figure out how they're going to help prop up the industry, the housing finance industry, this weekend. So I would think that rates are going to continue to drop. Now with the relock thing, if you did lock today, and then let's say locks drop to the bottom tomorrow, or rates drop to the bottom tomorrow, there's going to be opportunities out there to renegotiate that rate to take advantage of the lower rate, depending on how much they move. And it may or may not even be worth it too. Okay. So it's all, awesome. Everybody's different. Oh, and there's no such thing as a 0% interest rate.
Oh my gosh. So honestly, again, will show you my ignorance. When that happened and I was watching it on the news, I'm like, Sloan, they just dropped rates to 0. And we had just refinanced on Friday, and this happened Saturday. And we were like, oh my gosh. And then luckily, it was David Garcia posted on Facebook. He's like, FYI, that doesn't mean, that it's 0. I thought, oh, sorry, never mind. We're not
idiots. It's free money.
Yeah, I would just stress for every agent out there, if they ask, if they're curious about what the Fed funds rate is, talk to their local mortgage professional before putting stuff out there on Facebook.
Yeah, no, that's great information. Kevin, I would love for you to, ask Todd, direct some questions Todd's way. I know appraisals. I've already gotten some Q&As, and I'm letting folks know that we're going to get to appraisals. So will you take us there?
Yeah, I mean, I know just based on the mass amount of refinances that were going on, that we were having appraisals, the appraisals were dragging on forever just coming into this. So I'm wondering, what have you seen? Or you think, what do you need agents to do as far as a third party addendum or timelines? What do you need from us to give you guys time to get those appraisals? And do you think they're going to get slower or eventually speed up, or what do you think?
Great question, Kevin. And I know that's something that's been a concern for people throughout real estate histories, appraisals, whether it's value concerns or timeline concerns. And yes, appraisals have timelines have slowed down. Generally, we're seeing about a week to a week and a half longer. So, setting expectations is key right now, which is, I know why we're talking about this and why you're asking. But generally, when appraisals were taken a week and a half to 2 weeks before, now we're seeing that they're taking 2.5 to 3 weeks. And so when you're setting up a close date and setting up that contract, I would definitely go for at least 35 days if possible, 40, 45, just to allow for that. I know some realtors have some perspective that it might be better to go for 30 up front and then ask for more if you need it later. And some would be, no, I don't want to worry about it later. Let's just go ahead and ask for more. I'd say if you could get 5 days, go for that. They are taking longer. A lot of it has to do with the refinance boom, and appraisers are backed up. We actually work with appraisers directly. We don't use an appraisal management company, which we find is a benefit because our appraisers know us, we know them. They'll raise their hand if they're too busy and can't get it done in time, which allows us, we can still be compliant and rotate to the next person in line. So, you know, all in all, they are taking longer. It's not like they're taking a month longer or anything like that. So I don't think it's the end of the world, but do allow some extra time for that.
Do you think they're going to be going back to allowing some drive-by appraisals on certain neighborhoods, making it a little easier on the appraisers to get it done, or lifting regulations, or have you seen any of that?
Definitely, and that's something that's been very interesting. Is Fannie and Freddie have both come out and they're issuing temporary guidance. So this is for right now. During this, they are saying for conforming conventional loans, basically all the way up to 3% down, they are allowing for desktop appraisals and drive-by appraisals, so they don't have to go into the house. Now, there's a big paragraph in that guidance that leaves for a lot of gray area. Basically, they're saying if the appraiser does not feel that they can substantiate value without going in the house, then they're not going to buy that loan. They're not going to accept that appraisal, so they may have to go in. So that's for primary residence and second homes. On a second home, if they're putting less than 15% down, you do have to get a full appraisal, and investment properties as well. And then for refinances, if you're refinancing through Fannie or Freddie and they currently own the loan, they will allow for a drive-by if there's at least 15% equity. And another really cool thing is the GSEs, Fannie and Freddie, have been gathering appraisal data over the years, and they've got it in their databases. And now when we run automated underwriting, there is the potential that we could see an appraisal waiver or collateral representation is what it's called, become available. I had one in Kerrville the other day on a townhome, a purchase, didn't expect it. Everybody was concerned about timeline. Were we going to be able to close by May 6th? How long was the appraisal going to take? Ran LP and found out it qualified for collateral representation. We didn't have to do an appraisal, and we're able to now get it done quicker. So there is some relief there. Remember, it's temporary. We don't know how long this will go. We don't know if it's going to change and ease up even more or not. Another thing is, I know some appraisers are concerned. I mean, some realtors are concerned about, well, I really want the appraiser to do a full appraisal because I'm concerned about value. And just because the appraiser or the lender is going to allow for a drive-by or desktop doesn't mean that that's what has to be done. We can still do full appraisals if the opposite is true.
Okay. Nikki, I know you got real fired up when Amber was doling out different things that everybody gets to talk about on the forbearance issue.
Nikki's like, I got forbearance. I
have a list of questions. I'm not even going to ask them. Nikki, I want to hear from you.
How dare you go off the cuff, Kevin? How dare you?
You knew what you did when you asked me on here.
I sure did.
Forbearance versus forgiveness, which we know it's not, nothing's being forgiven. Just go. Give us the cliff notes.
So yes, thank you. So I think that it's super important that people understand what the differences are, and it's very clear. The communication that's being put out there thus far is clear that forbearance is not forgiveness. But what is being muddled is forbearance versus deferment. They're using those terms interchangeably, and they are not the same thing. And a lot of people are familiar with deferment because of student loans. So most of America, or a lot of America, has student loans, and so they identify and are familiar with deferment. Deferment is not forbearance. The issue with forbearance is the exit plan. It's not the forbearance itself that is the problem. I'm not even going to try to sell anyone on why they need to worry about the servicer's position here and how the servicer still has to make payments. That's not the individual homeowner's problem, right? So that's the servicer's problem. That's their concern. But here's how it will impact the homeowner, the individual homeowner, okay? So forbearance versus deferment. And I am in no way discouraging anyone to do it. I think anyone who is Anyone can apply, anyone is entitled to apply, and anyone who absolutely has to go this route, that's a decision that they make for their family themselves, and hopefully with a mortgage professional as well. However, they do need to understand, and there is a lot of national reputable misinformation out there, or things that aren't being addressed, and that's the exit plan. So deferment is when you stop a payment or pause it and it doesn't start again for a time period. So that could mean, like, for example, car dealerships do it. They stop a payment. How many times do you get that notice from your, car loan company around Christmas time to skip a pay, right? You qualify to skip a pay. You qualify to skip 2 payments. They take the payments, you don't make them, they put them on the end. It's no big deal, right? You don't get a balloon notice. You're not late on your car payment. It's no big deal. On a student loan deferment, same thing. You apply for a deferment for 6 months. They pause the payments. There's nothing reported negatively on your credit. Payments start in six months. It's simply the term of the student loan payment doesn't change. It just simply doesn't start for 6 months. Here's how forbearance works. You stop making your mortgage payments. So you call, you apply, and it's important to note, you don't automatically go into forbearance, okay? So you have to call your servicer, you have to apply for forbearance, they have to approve you, you have to be current, and then you can stop making your mortgage payments. Now you can stop making them in full. You can stop making make partial payments. You can make any level of that payment once you're in an approved forbearance plan. So they put your payments on hold, okay? Now, that doesn't mean that your payments aren't still, let me back up. So let's say you're approved for forbearance for 6 months, and then you apply for an additional 6 months at the end of that 6-month term. So let's say the average American needs 12 months. Because if you're truly behind, 6 months is probably not going to be enough. If you really are unemployed, you're really suffering from a large loss in income, most people are going to try to apply for 12 months. So let's say that your mortgage payment is $1,500, okay? So you stop making your mortgage payment, and that you stop making that $1,500 payment. You're 6 months in, you apply for another forbearance, and 6 months later, now you're 12 months in, and you've had 12 months without that $1,500 a month mortgage payment. At the end of that 12 months, you're gonna call your servicer, or they will call you, and they're going to let you know that the balance is due on the 12 months that you have not paid, okay? So you have an $18,000, wait, am I doing the math right here? Hold on, let's see here, times 12, yes, 18, just to make sure, because it just shocked me how much money that is. $18,000 at the end of that 12-month period. Now, I got news for you. If the average American homeowner who applied for forbearance had that $18,000 laying around, they would not have gone into forbearance. So you think about what's worse than having to make a decision to not make your mortgage payment, right? Getting an $18,000 note at the end of that 12-month term, okay? This is not, hey, how some servicers are gonna do it. This is just how it works. They cannot put the payments on the end, okay? You sign a note when you get a mortgage. It is for an agreed on term, for an agreed on rate, and you cannot just tack them on to the back. It legally doesn't work that way, okay? So you're gonna have options then. Option one, the servicer is gonna say, hey, you owe us $18,000. How would you like to pay that?
Can I put it on a credit card?
Let's get to that. So the service, that's gonna be between you and your credit card company. I don't think most of them don't take credit card payments on the mortgages, but so you're gonna get to the end of that term. They're gonna say option one, you can pay us $18,000, okay? Option two, they will give you, and all of these options are between you and the servicer and subject to approval of your servicer. Okay, so it's important to know that they get to approve. So bottom line, you owe $18,000 at the end of that 12 months, and they get to decide with you how you repay them. Okay, now at this point, whatever moratorium is on foreclosures will be lifted. Okay. I mean, this is important to note that this is temporary. This, not being able to foreclose is temporary. Okay, so at the end of this term, option 2 will be you will have a reduced amount of time where you can repay this. Think about this like how many homeowners have had their escrows be wrong because the taxes have went up. Everybody's taxes went up the last 2 years. So taxes go up. How painful is that 12 months, that 12-month period that they have to repay? Not only have the taxes increased, but now they have to repay the shortage. Now take that and assume that it's a $1,500 a month mortgage. Now let's say that they give you an equal repayment term that's equal to the term of the forbearance. Now so far, I went to 5 of the top servicers across the country and research and looked through their FAQs. No one is committing to a repayment term. I personally do not think they're going to give you the forbearance term to repay it. I think you'll have a couple of months at best. But let's just say for argument's sake that they give you the equal amount of the forbearance term. So they say, I tell you what, we'll let you repay this over the next 12 months. You were in forbearance for 12 months. We'll give you 12 months to repay it. Your $1,500 payment is now $3,000 for the next 12 months. Once again, the average homeowner cannot afford to do that. Okay. Now, here's the third. Everybody says, well, I'll just refinance. No. You go into forbearance, you no longer can refinance. You are not eligible to refinance until your forbearance balance is brought current. That is the most painful part of this whole thing, okay? Is that everybody's talking about rates are gonna be in the 2s. They're gonna cap out at 2.5, 2.75. Awesome. If you're in forbearance, you're not getting it. You cannot refinance yourself out of this. Every single one of those top servicers, clear as day, black and white, you will not be eligible for a refinance, okay? So another option, people are talking about, well, we could put, we'll be able to take those payments and put them at the end. It's possible for you to for there to be some funds available where you can where they can amend your note and you can get an additional lien behind your lien and then whatever those repayment terms are. So far, nobody's posting it. Nobody has any guidance on it. And honestly, I think that until the federal government provides some funds available for these servicers to use that, or some sort of zero interest finance or a negative interest so that they can make money if they allow people to do this, something to incentivize them, it's not going to happen. That will be the least likely option to happen. Now, another scary part of this is I have seen guidance on 40-year modification options. Literally, like heck, after 2008, they got rid of the 40-year loan for a reason, because it was predatory lending. Okay, I don't know if that's a legal phrase, and so I probably shouldn't say it, but it's true. Nobody does them anymore because it should have been illegal. And so because of the interest that you pay, and I just, it's the exit plan and the lack of great options that scares me for people. And then there's the F word that everybody's really afraid of, and that is foreclosure. And that is a real option if you cannot make your payments at the end of this forbearance. You face the real possibility of foreclosure. I'm not saying that this is going to happen, but if you don't understand what you're getting into, then you shouldn't get into it.
So who do you recommend that homeowner talks to? Because I'm sure as hell not giving anybody advice on whether to skip their payment. And I know you don't want to either. Is that a financial planner? Is that, who do you recommend they talk to? An attorney?
So I'll tell you, so there's a couple of different things. So one, you should, if you are comfortable with your agent, okay, now the agent, I'm not suggesting the agents you give financial advice or mortgage advice at all. But I do think if clients are comfortable with their agents, and I would love if every agent that sees this went through their past client database and started calling them and saying, would you like any information on this? Would you like me to connect you with somebody who can talk to you about this? Guys, be proactive. I have educated, successful clients asking about applying for forbearance just because they're like, well, but it gives me a little bit of a break. They just don't know. And so to answer your question, I would say agents proactively reach out to your clients. And as you're going through that check-in call with them, asking about family and housework and how are they hanging in through this, Easter plans, ask then the question about, have you looked into forbearance? Do you have any questions about it? I saw an interesting webinar. I'd really like to connect you with somebody who can talk to you about it before you do that, if they are showing any interest. If they're comfortable with the loan officer that they worked with originally, call and ask. I do think that it's super important that they call and talk to their servicers as well. Here's the only problem with that. The servicers, you're going to be on hold possibly for hours, if not longer. I would recommend they go to their individual servicers. Every single servicer has an FAQ site on forbearance right now. Every single one of them. So they can research it, they can read. The servicers aren't necessarily going to mislead, they shouldn't intentionally mislead them, but the information that is presented is not always explained in a way that clients can understand. And it's important for me to say too, the servicers are not winning here by the clients going into forbearance. So they're not going to mislead them into forbearance for their benefit. It's not going to work that way, but it doesn't mean that it won't happen accidentally. And so this is a time of, like, we all have an opportunity to be the educator, to be the leader, to explain to people what this looks like and what it is. Like, I'll tell you, here's how I'm explaining it to people. I have got cost cutting exercises. I've got things that they can check, other things that they can refinance, other things that they can put in deferment. Like, I'm going through all of it. Guys, if they refinance right now, and rates are good right now, yes, are they probably going to go down in the next 12 to 18 months? Probably so. But if it's refinancing now in the 3s, you know, or going into forbearance, I would look at that as refinancing now. They can, I mean, we're not supposed to say it like this. Yeah.
Nikki, so Chad Nell is asking a question relating to forbearance. So he wants to know, is the interest calculated the same for the forbearance and deferment?
So there is no such thing as a mortgage deferment. So if you're asking about forbearance, so there's not interest being, great question, by the way, there's not interest being, there's not additional interest being charged on the amount that's in forbearance. It's just the regular amount of the principal and interest payment being tacked aside. So that amount is not growing additional interest. It's just the principal and interest of the original payment itself. So it's just not being paid. It's on hold, but then instead of it going on the back or it picking back up again at the end of the forbearance, you actually owe the balance.
Good info. Okay. Back to Lori. Lori, I had a deal a few weeks back, right when all this started happening. It was before everything hit the fan officially, and it was about $1.2 million, $1.3 million deal. And lender just started going radio silent on us. And I started to get, again, I've been through 08, so I know what that means. Yep. And I started to make some calls and finally got to the bottom of it. And this is a client, smaller lender that a client had a long history with, and said, "You guys are out of money, aren't you?" And they go, "Well, you know, him and hawing," and finally came out, all their investors pulled out on the jumbo loan. Now, we were able to pull them out and move them over to another lender that they had some history with as well. And it was a great portfolio product. And these people were perfect. They were the perfect loan. They're going to make a lot more money during this mess because they own a big healthcare industry business. So, but what are those red flags we need to look for? Because there is going to be some of that.
There is.
You know, a lot of agents practicing now don't remember the times of getting to the closing table, signing the papers, only to fax over the papers when we still fax over papers, and there was no lender to fax it to. Right. And they had closed in the process. So what are some of the red flags or some of the questions we need to be asking of our lenders up front, and at what point during the deal? You know, none of them are going to, you know, a lot of them, the smaller ones having trouble, aren't going to be 100% honest with us. But what are the questions we need to be asking?
Well, I think you kind of hit it, nail on the head of the nail, right? You know, when the lender starts stalling or not getting back to you, that's kind of an indicator. Okay, why are they stalling? You know, what is going on that is delaying that loan from moving forward to that contract date, right? And so I would have that candid conversation with the loan officer right out of the gate. You know, understanding their source of liquidity is key. Not that they've got to get into the details, But you can ask a general question, hey, how are your, investors? Because, particularly with brokers, they're not putting those loans on their books. Generally, they put them on their warehouse line and then they immediately sell them, right? So just having that candid conversation, particularly in the jumbo arena, and you gave a great example. Yesterday, my AVP in secondary got a phone call from a small community bank that said, hey, I went to price this loan out with my go-to investor, had a relationship with them for years, and they gave me a rate of almost 5%, which in this market, you guys know that's a high interest rate, even on a jumbo. And then they told him they would charge him 53 basis points to deliver that loan. And he had just about fell under the table. And so I think having that open, candid conversation, as an agent, talking to the loan officer, asking how it's going. I'll be candid, lenders know when they're starting to get into that crunch, because they're going to know, they're even getting notices from some of their investors saying, look, guys, we've suspended. We're not going to take any new loans in. I'll give you a great example. Wells Fargo's been very open in the market that they've kind of shut down their TPO channel on jumbo loans. They were a huge outlet for a lot of mortgage lenders to be able to sell those jumbo loans to. They're still doing it on the retail side. They're just not doing it on the third-party originated loans, right? And so I think knowing that, looking at what interest rates being offered to the borrower, when you're kind of getting such a higher rate as compared to where the market's at, that's telling you that whoever they're working with is trying to slow it down. They're trying to take less loans in. The jumbo market's a little upside down right now. A lot of people are pulling out. The investors want to go more with the government-backed, mortgage-backed securities, so they got a guarantee of income coming in. So for us, we have a retail channel, but we also have a small indirect channel, and those lenders are in Colorado and Utah. So we've told them we've communicated positively. We are in a great position. We are not going to shut down, that being an outlet for you. We're here to kind of help you navigate those waters, but we're blessed and fortunate as almost $10 billion company, well capitalized to be able to continue that stream. But we also don't, have a huge indirect channel. But I think those are things from a liquidity standpoint. If I were the realtor, I'd be talking to that loan officer. They're your best source of information. And so when we're looking at it, lenders, loan officers, we keep our loan officers well advised of what our position is. So when an agent calls, we can reassure them. We can give them confidence that, look, we're here for you. We're going to be able to fund the loan as scheduled. But again, you hit, Kevin, you nailed it. When they stop talking to you and they're not getting back with you, that's your heads up. Something's off. We do. Loans are taking longer from the appraisal standpoint. I know Todd talked about that, but also title. On the title side of the business, I'm blessed to get to work on both sides of that. And Nikki, I get to share in the servicing pain because servicing reports to me as well. So we are ramping up for the forbearance tidal wave that's going to hit us as these borrowers come out of their forbearance that they've accepted. That's going to be the ripple there. But back to the liquidity side of it is just having that open, candid conversation with the lender, kind of find out, hey, is everything good? Do you have this loan priced out? Is it, just asking that can kind of help you stay in touch. But just recognize, just because a loan's taking longer, it may not have anything to do with liquidity, right? It could just be, with courthouses closing, it's taken us longer to get the title commitments back. And that's 7 to 10, business days for us to even get title back in counties where we usually get it back in 24 hours. So it's really put a strain all across our business. And kind of back to that first question, how does it relate to what we've been through before? It is hitting us from all sides. But I feel positive. We are here.
Thank you, y'all. So panelists, and for our audience, and the audience numbers is growing, which is great. So in the next 10 minutes, right, here's what we're going to cover. So panelists, let's kind of keep it going fast because I want to make sure that we're going to talk about loan products. We're going to talk about jumbo rates. We're going to talk about contingencies and contracts. So lots to cover in the next 10 minutes. So let's keep it going. John Hudson, I'm throwing it your way.
All right.
And what I want to ask you is what loan products are being most affected right now? And if you can just let us know, like, what loans are easy today and which ones are harder or maybe non-existent.
Well, Amber, we're pressed for time and you ask a loaded question. So first of all, everybody's different. So to say that any mortgage loan in today's environment is easy is just simply not true. There are some that are easier than others, but I think it's dependent on the borrower. Number two, every single loan product out there is being impacted. As you heard from Lori, I mean, even on the jumbo side, it's getting crazy. I think the folks that are getting impacted more temporarily right now than others are definitely folks that have, particularly first-time home buyers that may have a lower tier FICO score. And that's all because of the risk appetite that's out there. And the statisticians are saying that there's a greater likelihood of forbearance or default for people in this credit tranche than in this one over here. So, right now, yes, there is definitely credit tightening, but that doesn't mean that there's still not outlets for it. I think, the best way to describe it is that, again, it's very fluid. There's still, down payment assistance programs that are being offered. However, there's little caveats now because some of the down payment assistance government entities are asking for attestations from the executive officers of mortgage companies saying that that borrower is not going to go into forbearance in 90 days, which it's impossible to even, ask somebody to sign that. But definitely government products seem to be hit the hardest right now. And then a couple weeks ago, we saw, non-QM, non-qualified mortgage, your specialty loan programs virtually disappear overnight because, again, it's all an appetite of risk. So, it's fluid. Again, I would just stress to real estate agents out there, every borrower is different, and talk to a local mortgage professional that's going to sit down virtually with that borrower and really explore all of their options and present as many options as possible.
So John, Melanie Ruiz wrote in a while ago. She asked for an update on DPA programs. I'm assuming that's a product.
Yes.
Can you touch on that quickly?
Yeah, so down payment assistance programs, they're still out there. I mean, those are programs that are funded by government bonds, like directly from the Texas government. Same thing with the Texas Veterans Land Board loan programs. Those still are available and still go down to the lower FICO scores. But I think you're going to see some more tightening possibly. And again, it's all very fluid, and again, fortunately there's multiple down payment assistance programs that are out there. Because if I have this one over here that's basically telling me that they're going to make me as an executive officer sign an attestation form that that borrower is not going to request forbearance before they purchase that loan, I'm not going to do business with them. But I have other outlets over here. So there's lots of options. And again, I think it's just talk to your local mortgage professional and ask them.
That's awesome. Well, Kevin, you do a lot in luxury. And so I know jumbo is probably more relevant to you, right, than it is me, because I don't. So
Jumbo's a lot. There are a lot of people that still, jumbo doesn't mean $1 million.
Right. Okay.
Jumbo loans are still in the normal price range. So Todd, let me ask you, what are you seeing on jumbo rates? Are you seeing jumbo money out there? I know Lori answered some of that. Look, for a good qualified buyer, they're going to be able to find some money, but what are you seeing in the jumbo market?
That's a good question. John and Lori have both kind of hit on this, and for sake of time, I'll be quick. But basically, in the secondary market jumbo arena, back on March 18th and 19th, the bond markets, they locked up, and liquidity is gone in the secondary market for the most part for jumbo loans. So if you're finding a fixed rate quoted in the secondary market, it's going to be extremely high, like Lori explained, with a lot of cost to it. And there's the chance that it may not even close. What we're finding is like portfolio lenders or lenders that are lending their own money like ourselves and who are well capitalized are very interested in doing jumbo loans right now. So they are available. A lot of times you're finding that they're offered as ARMs, and that these ARM rates are actually a lot better than the fixed rates. because they can account for the risk that comes with the loan, and also for fluctuations in the market. When the rates go up, lenders get to take advantage of that, of course. But you know, all in all, we've seen the secondary market in jumbo pretty much go away. I'm not saying there's not people out there doing it, but looking for a portfolio lender who does jumbo is really where they're going to find the most success.
Very cool. Thank you.
I heard Chase is doing them. I mean, right? Like I
A lot of them are doing them. Most of
the
the big banks have portfolio, especially that have private wealth departments have portfolio products, and it's a lot safer place.
Okay.
Right, and I was just going to comment on that, and that's where if it's a real high tier client, especially with a national bank like that, then there's opportunity for that.
Thank you.
Nikki, contracts. I know we touched on extending the closing dates a little bit and just giving you guys some extra time. There are all kinds of new addendums that pop up during this time. I know Texas Real Estate, I think it's either TREC or TARF, put out a COVID addendum, which allows for an automatic 30-day extension. Do you guys like seeing those additional addendums? Do you hate seeing those additional addendums? Are there any verbiage we need to put in or leave out during this time?
So we are resilient. You send in those addendums however you like, and we will figure out whatever it is that you guys add your contracts, take out of them. We'll figure out how to navigate it. I'll tell you, this is like letter of the law versus spirit of the law, right? So if you put your COVID addendums in, then letter of the law says, hey, I can still put my 30-day, date in here, and then I'm protected by this addendum, right? But spirit of the law says, hey, who appreciates that, right? Like if you know going into it, hey, this is what the one good thing about COVID is that like we're all on the same playing field right now. We have to communicate with each other. It's an opportunity for us to proactively reach out to the other side and say, hey, listen, I've got a pre-approved lender, a pre-approved buyer. I have an approval letter, not just a random pre-qual from some random bank. This is a local person who's looked at them, who's advised them. They're telling me that we can close it in 30 days, but how about we do this? Let's put a 45-day, 30 to 45 days on this contract. Let's let everybody know that if it can close earlier, we will. But let's be proactive in setting an expectation that deals with potential delays. I'll tell you, we're not really seeing delays on our end. We're not we are doing refinances, but we're not inundated with them. We've made it very clear that our primary source of business has been purchases and will remain purchases. And I think that the refi clog is causing more delays than COVID delays are. Now, sorry to be the bad guy that says that, but that's what I'm seeing, is that it's more companies are inundated with refi clogs more so than COVID, because most people are still working, but responsibly. So I think that the addendums are great. I read them in detail. I think they're great for all parties. We're not actually requiring them in underwriting or seeing that, we're having to add them or that's holding anything up. But there are some things that we're all having to do, like the day of closing or right before closing. That would be nice if everybody was proactively communicating. Like, we have to get verifications of employment the day of closing to make sure that these clients are still employed. We have to get, most recent bank statements and pay stubs. Whereas before it was like, yeah, if they're within 120 days of closing, we can go with it. Like there's a lot of things that are tightening up that could cause not delays, but more, a little bit more turbulence along the way. And if everybody's proactively communicating those things together, there's no fight. We just know it's coming. We handle it, we adjust, we get it done. So I don't think that that you need more than to say, hey, between 30 to 45 days, I don't think there's any local lender that I'm seeing, that isn't going to be able to accommodate that, or at least let you know that they can't. But I think it's more important than ever, get your clients approved. If you are a listing agent and you just get a random pre-qual, don't take it. Like, do not take these letters. Or if you're seeing a program that you don't think exists anymore, reach out to the other lender. Reach out to the lender, proactively communicate and find out if this is going to be a problem. If they don't take your call, that's an issue. That's a bad sign. Your clients need approvals. If you are showing them houses, they need approvals. If you are taking contracts on your listings, they need approvals. You owe that to your clients right now to only work with the people that are serious. And we're seeing right now the people that are moving are serious because they have to. I mean, if you're moving during COVID in your masks and your gloves, it's because you had to. And so I just think that the proactive communication is more important now than it ever has been. And I hope that that's a permanent change. Like, I love getting calls from listing agents and saying, you know, hey, I saw your name on the letter and I'm pumped. This is legit, right? Yes, we're good. Let's go. That's the kind of thing that we want to see stick around long term. So
that's awesome. You guys are a wealth of knowledge, and I'm so grateful for just the collective wisdom, because, you know, it sounds cheesy to say, but it's true, right? Like, we will get through this, and we're going to get through it together. And I really believe we're going to come out stronger, right, for having done that. We've all adapted new ways of communicating. We're finding new ways of working together, right? So what a wonderful thing that we're able to come together and offer this up for the 100+ people who have these great questions. So as we go to close, Kevin, let me ask you, right? Can you give us some joy, right? Share with us, like, from your perspective, close us out here on a good note, right? We know that real estate is still functioning, right? We just had to figure out a different way to do it. So that is something that we're all grateful for. And so I know that within the mess and the clouds, there's a lot of great silver linings and opportunities. So Kevin, will you, in this, I guess, on a positive note?
Yeah, I was talking to a buddy of mine the other day and reminded of a real pretty deep quote. There's a psychiatrist named Viktor Frankl who was in the Holocaust. He was a prisoner in the Holocaust, and he came through it and out the other side, and one of the few that survived. And he wrote tons of books, and there's one quote in one of his books. It says, "Everything can be taken from a man but one thing, the last of the human freedoms, to choose one's attitude in any given set of circumstances." We've all been through life, every single one of us. Nobody gets through life unscathed. Nobody. We've all been kicked in the gut with something: cancer diagnosis, car crash, job loss, infidelity. What do you want to do? Everybody's been affected by something. And what those of us, once we get through that thing, we can always look back and see, something good did come out of it. There was something good that did come out of it. It sucked while we were in it, but something good came out of it. And we're just all going through the same gut punch together right now. This is not going to kill our country. It's not going to kill the world. The virus they're already having all kinds of good news on this thing. The death rates are very low for what it is. We're going to get through it. So just suck it up, choose how you're going to respond. Take this time to reach out to clients. I know for me, it's just made me thankful. I've been very blessed in this business to be able to look back and say, golly, this client that referred me 10 people, I wouldn't be able to sit here on my back porch hanging out, not worried about my next mortgage payment if I hadn't had that person in my life 5 or 6 years ago. It's a good time to reach out and say thanks and just kind of take stock of what we've got. Absolutely. And don't use it to get new business, but just say thanks. It'll result in new business. But just take the opportunity we have and realize what we got.
I love it. Well, it is a holiday weekend. The silver lining, I know, for a lot of us has been this unexpected increase in family time, right? Todd, you made a joke yesterday, the COVID-15. I'm like, yeah, we're cooking, we're baking, we're walking, we're biking, we're talking, we're Skyping. Like, there is a lot of good positive that is coming out of this. And one I'm actually grateful for, right? So I've got a new perspective. So with that, I just want to thank all of you guys for your time. Thank our panelists. I want to thank everyone who registered. You guys are helping to support Platinum Top 50 right now during this time, and I'm so grateful for that. So let's just keep doing the good work, and we are here to support you. We have a lot of great more webinars lined up over the next couple of weeks, so we can stay connected through this time. So look for some of those to hit your inbox, but hopefully you're not doing much of that right now. Hopefully after this we're all going to go spend some time with our families and enjoy it for what it is. So thank you guys so much. This was wonderful. I appreciate all of you, and I hope you have a great long weekend.
Thank you for
Thanks,
pulling it together.
Amber.
Thank you, Amber.
Bye, guys. Take
Yeah.
care.